Hey, it's Tim and Lisa, and you're listening to the REI Concierge podcast. The REI Concierge helps Americans living abroad find and buy great investment properties in the U.S. From analyzing markets to finding local partners to closing your first deal, we are partnered with you every step of the way. Let's jump into today's episode. Hello, and welcome back to another episode of the REI Concierge podcast with Tim and Lisa. We are thrilled to be joined with David Shaw today. David is the owner of West Florida Invest, and he has decades of experience as a real estate investor literally around the globe. So we are really excited to have David on the show today. David, welcome.
Thank you so much, Lisa and Tim. I'm excited. I'm pumped. Let's get going.
We have to pull back the curtain on what just transpired not 4 minutes ago before the podcast, because we have to start it this way. So David jumps on from Florida, and he's got like these screens up where he's literally bidding on a judicial foreclosure as we speak. And there was like 50 seconds left, and he was the high bid. And then he goes to show us how he calculated his ARV and all the numbers that he ran and what goes into the madness that is the final amount that he was willing to bid. Flip back to the screen, and someone had outbid him by like $100.
And it's all our fault.
We start off the podcast. It's totally our fault. He was showing us how he calculates the numbers, but he's got a smile on his face because, like you said, I mean, you do this all the time, and 98 of them about go with your expectations. One far surpasses it, and one is kind of the dog of the race and just way far below what you expected. But anyways, we just had to start off with that. We just witnessed a bidding loss on an auction. So David, I'm sorry, but welcome. We're glad to have you here.
Hey guys, listen, it's you have a lot of irons in the fire every single day. That's when you run a business kind of like ours, we're a pretty high volume fix and flip business, buy and hold business. We do kind of a number of those kind of activities. So, when you're high volume, it's kind of easy come, easy go. I'm really bummed that we missed out on that one, but it was a really nice house as well. I'll hold it against you for the rest of my life, Lisa.
This is a great way to start an interview. This is good. We're already in the podcast. Congratulations, guys. Your podcast is really good so far. I've been really enjoying the episodes. I really enjoy what you guys are doing. I think you're really adding a lot of value to the space. So well done.
Thank you so much. That means a lot.
Yeah.
David, tell our listeners who you are. Give us a little story of David Shaw, your background, how you got into real estate. And I know this is a huge story, so pick the highlights that you want to.
Yeah. I'll get through it as painlessly as possible. I'm Irish. I'm from Dublin in Ireland. Just like everybody else, I graduated university, and I was a construction project manager post-university. That's what I did. In my career, I worked that construction project management space in San Francisco and New York and Ireland. And I just really wasn't inspired by my day job. I guess that rings true with an awful lot of people,
Yeah.
And in that, I started investing just a little bit on my own. And I made some pretty decent decisions in around 99 and 2000 and 2001, around there, start picking up some inventory. And in 2005, literally a little birdie whispered in my ear and told me to sell everything. A good friend of mine in Ireland, he was a big currency exchange trader for one of the large banks in Ireland. And he was selling all his own stuff. I was like, what's going on? And he's like, well, I don't like the landscape. I think stuff is going to start changing around town. And he's selling his own house. So I was like, I don't know much about it. I'm just in construction, but I'm going to start selling my stuff. So I ended up in 2006, kind of got rid of everything I owned, including my own personal home and everything else. But I ended up with that old problem. It's like I had cash and the market was kind of crashing down all around me. So this kind of inadvertently my segue into real estate, in that I needed to do something with the money that I had. And right at that moment in time, the best buying opportunity in a century presented itself, but I didn't know how to maximize it. I wasn't an experienced real estate investor at that point in time. I liked a lot of what other people were doing as the EU was expanding, and interest rates were coming down and down and down, like places like Lithuania, Latvia, Bulgaria, Romania, Romania, Poland. There's a lot of buying opportunity in these towns or in these cities, the main cities in these countries. So there were companies that were kind of just they call themselves emerging market specialists. So there's companies that were doing this at that time, and I really wanted to kind of know more about how to do some value investing. So that's kind of where I learned to underwrite, kind of where I learned to the importance of cash flow and the importance of strong underwriting, the importance of a fairly fundamental approach to what investing should be about. And from there, I got in contact with some of these companies. One of them invited me to come and work for them for a little while, and so I took a 98% pay cut to go work for a company like that, just because I really wanted to learn. I really, really wanted to get into real estate investing because I'd made so much inadvertently. I was like, okay, if I professionalize this at all, I can definitely get out of my day job. So then in kind of 2007, so I worked for a company. We were doing some projects in East Germany. It was then obviously Germany, obviously Berlin. We were doing stuff in Poland. We were doing stuff in Belize. We were doing stuff in Panama City. We were doing stuff in Buenos Aires and Argentina. And then kind of really like 2008 started to make its way around. And I'm sitting in Dublin, and I know there's a massive opportunity in the US in general, because it's obviously the blood is on the street by mid 2008. So I flew over to Florida, and I tried to figure out, okay, what can I do here? How can I take advantage of these prices that are falling? And the dollar had actually fallen quite a bit at that time as well. So I tried to learn, what are these short sales that everybody's talking about? How do I get in touch with these banks? Everyone's talking about the banks. How do I get in touch with them? What are these foreclosures that people are talking about? So from there on in, I found it was very, very clunky and almost unworkable to try and build up a portfolio or build up a business around short sales at that time, because the banks themselves didn't really know how to deal with them, Interesting. The banks were only learning it. Now, the big institutional investors were not there yet. So I kind of settled in on a business model that was, there was a lot of these condo conversions. So these are garden style apartment complexes that you see all over the state of Florida. Well, a huge amount of people had converted those to condominiums, a lot of developers, and they were selling these things at $220 a door or $230 a door. Fannie Mae and Freddie Mac were funding them, and everything was going well. Well, the big lenders stopped funding them overnight. Fannie Mae, Freddie Mac just cut funding from underneath them. So now these things, they couldn't give them away. So they went from 220 to like 80. And when that happened, there was a race out the door. And not only was a race out the door, but obviously all of the HOAs themselves stopped being paid. Okay, so you got people en masse not paying the homeowners association. So the buildings themselves are in risk of going into disrepair and the like. So I had built up with my business partner at that time. We'd gone out on our own to take advantage of this US opportunity. So we came in and we took out basically all of these condominium communities that were too small for the big guys, so like kind of 30 units and above, but too big for too small for the big guys and too big for the small guys type of thing. So anything from between like let's say 30 and like 180, 190 units, we'd go in and we'd negotiate with them. We'd take their inventory, we'd bring it back to Europe. The rents always stayed stable. So, we were getting 10, 11, 12% cap rates. Wow. We had to do nothing at all. They were already renovated. They were already clean as a whistle. We literally just had to take them, bring them out to Scottish investors, Irish investors, Scandinavian investors, English investors. We sold literally thousands of them. So we were the solution, myself and my business partner. We came in and we offered that solution to the condominium community owners, but also to the European investors. And, we're literally the first company in here offering that opportunity. But then 2012, and we did that 2009, 10, 11, 12, 13. But by 2014, the inventory that was left was getting worse and worse. The yields were getting compressed. The institutional guys were coming back type of thing. And so I moved into, again, I started scanning the marketplace for yield. And so, we just started basically buying and renovating single family homes. And we've done that in mass over the years. Probably, at this point in time, I've probably renovated, well over 600 single family homes myself personally. And here we are talking on this podcast. So, let's talk. I built up a portfolio. Yeah, I built up a personal portfolio as well that it's kind of given me that, there's one thing that a lot of people confuse out there, like, a busy realtor or a busy fix and flip guy. Somehow, some way, he's a real estate guy. Yeah, he knows how to do fix and flipping. But just like you guys, and just like everybody listening to this podcast, it's also incumbent on me to build up my own real estate portfolio, because fix and flipping is just a job. That's all it is. Yep. Right? You can do as much of it as you like. You can do tens of thousands of homes. You've got a hard, busy, well-paying job, but you're not creating any kind of meaningful wealth. And what we're going to talk about today is how people who have really busy jobs and busy lives and busy careers, we're going to talk to them, or I'm going to impart what I've learned over my career as to how those people can create meaningful wealth. Because I have to, in order for me to create meaningful wealth, I have to do exactly the same things as what we're going to talk about today.
So that's a great segue. I know. So like David, when you and I first talked, I don't know, over a year, when we were looking for, trusted partners in Florida for our clients, and you really harped on the idea of time. Real estate is so much all about time. And then when we spoke recently, you said, you've really built out what you call your E=MC² of wealth creation when it comes to real estate investing. And that's really the debt times time times scale equals your wealth. So now that I've kind of laid the stage, we want to hear all about that, because obviously you have all the experience, and you've done this for yourself, and you've done this for clients, and you teach folks that this is really how, like you said, you can do these fix and flips, you can do the wholesale, but if you're really looking to create wealth, that's just a full-time job, and it's a hard one at that. Like, it's good paying, right, but if you're not reinvesting that into your own portfolio and building that passive wealth for you and your family, then you're just going to be working for the rest of your life. So walk us through your kind of your formula for putting this active income into your passive portfolio, and how that works over time, and how you want to scale it, and just kind of go with whatever direction you want to go in that, because I'm fascinated by all these formulas you put together and stuff.
Well, that's right. When you have a busy, well-paid job, there's one thing that happens kind of once a year that starts to really impact you after it's happened to you a lot. And that's when you start paying the IRS vast amounts of money. That is, as much as I love infrastructure, and as much as I love this country, and I'm a citizen of this country, paying vast amounts of tax year after year after year gets a little bit redundant after a while, and
it's a little
you're like,
old.
okay,
Yep.
Yeah, well, so each time you sell a house, you create a tax event. That's basically what I'm saying. So every time you pay or every time you do anything, you sell anything in life, you're largely creating a tax event. And if you do that enough times, after a while, you're like, what am I doing wrong? So I can tell you, basically, my parents never pulled me aside and gave me any kind of financial education. I come from a standard middle class home. I had no guidance from anybody above me, below me, or around me over the years. These are just whatever we're going to talk about over the next a couple of minutes is really just my own personal experience. And it's what I've derived from my own experience of being out there, building up a real estate business, paying taxes, and like, what am I doing wrong? I thought I could outrun, I thought I could make enough money that I could just create wealth by creating enough passive income, or overwhelming passive income, and somehow, not passive income, active income, that I could somehow get wealthy. Now, what I have realized all over my life is that it's about scaling yourself, right? So most of us go to work every day, and we have a job. Now, you can't send two of you to work, right? You can only send you to work. You're the only person. So you kind of tap out at what you can scale yourself to be. Now, some people, don't get me wrong, some people can be the CEO of large tech companies, and they can create, or they can generate a lot of wealth for themselves through active income. But most of us don't. Most of us don't own a business we can scale. So basically, there's three ways I've found that people around me have made wealth in their lives. They own a business that they've been able to scale, okay? And they've gotten to the very, very top of a very, very large public company, which is very, very, very few of us are going to get there.
Very rare.
Are they born wealthy, or they've invested their way there? That's basically it. And so if you have a busy job, and that goes to most people that we're kind of talking to here today. If you have a busy job, you know, the one thing I hear over and over again is, well, I'm so busy. Well, I've got, you know, the podcast that you guys did a couple of weeks ago where you guys discussed the 5 profit centers of real estate. Those, they're the basic foundations of understanding why people should invest in real estate. Okay. I'm not going to rehash them. You've already talked about them at length, but actually I'd like to take it on an extra step, because I've dealt with literally thousands of investors. I've been on the phone with thousands of investors, and most of my investors are extremely well paid, Silicon Valley type engineers. So I would say that that's your typical investor that I'm on the phone to each day. And they, for the most part, investors get caught up in a number of traps. I only know these traps because I hear about them every day. I've done them myself. I've been guilty of every single one of these. And basically, you know, we get caught up in our own fears about what's going to happen next year or the year after. What's going to happen to interest rates? What's going to happen to the next president? What, you know, anything that you want to put in front of you about trying to foretell the future. Yeah. We get caught up in a fear of debt. Okay, I'm going to take on, you know, I'm going to get into real estate, but I'm going to do, you know, I'll just do one deal and see how it goes. I'll do 2 deals and see how it goes. Another big one is that we get caught up trying to speculate that, you know, we buy a house in an up and coming neighborhood, and, you know, we're like, okay, cool, I got a house in an up and coming neighborhood. I bought it for 200,000. It's now worth 400,000. I'm like, that's fantastic. Did you buy more in that neighborhood? I was like, well, no, now they're 400,000. Of course I didn't buy more. I'm like, you're not creating meaningful wealth. You did well, but it's not scalable. You can't continue to, that's not a business model that's scalable, where you go out and you find up and coming neighborhoods and you consistently get that right throughout your life. It's just not a way. So all of these things that I've just mentioned are the things that, you know, every single one of us start out when we're starting, and we make out all of those mistakes. We all want to get the up and coming neighborhood. We all want the home run. We all want to, you know, be cautious and careful. We all want to try and predict the future. Well, I've come up with a wealth algorithm that negates every single one of those. It literally clears the air, almost like the Matrix. If you've ever seen the movie The Matrix, and at the end of that, Neo sees the Matrix. Well, this wealth algorithm to me is the Matrix, and the algorithm is debt by time by scale equals your wealth. Now, we're going to dig into what is debt, what is time, what is scale, and what is your wealth, because they are directly and inversely proportional to each other. If you don't understand debt, right, and you're afraid of it, you're going to waste your time and you'll never achieve scale and you won't have wealth. If you are 99 and you're finally, you see the Matrix and you're 99 years of age, you know, sorry to the 99-year-olds out there, but you probably don't have a great deal of time left under which debt and scale do their work. Okay, so I will talk about what time is, and because time isn't just the physical time you need for it to happen. It's about your relationship with your assets. It's what's happening over time. It's what's happening to your life over time. So we'll talk about that in a moment. And then you have scale. There's no point in saying, okay, I'm comfortable with a little bit of debt. I've got lots of time, but I'm not prepared to scale. You won't have the wealth. So the way that I have figured out to quantify this for investors is as follows. Okay, so I talk to people all day, and they're caught up in all sorts of, you know, these kind of fear cycles, or they're, you know, partial cycles where they're doing a little bit of real estate, but they're not doing any kind of meaningful real estate. If you want to change your life, you ask yourself these 2 questions. Number 1, if you were to give up your job today, completely give it up. You know, nobody's paying your phone, nobody's paying your health insurance, you know, nobody's paying for your car, nobody's paying, no benefits other than just you on your own. What would it cost you and your wife or your spouse, you know, what would it cost, or just you alone, what would it cost you to maintain your lifestyle at least as well as you do today, just in terms of monthly expenditure? So that's the first thing that most people want to cover. They want to cover their monthly nut. I've asked no fewer than 400 people this question, so I can kind of tell you. You know, single people, basically it ranges anywhere between 6,000 and 9,000. and people who have, wives, children, kids, cars, all that kind of stuff, it basically runs between 12.5 and 15,000 a month. Okay. So I'm going to take kind of an average number of, let's say, 12,000 a month. Right.
Okay.
That's your nut. Okay. Now, now we know how we have a goal. We want to, it costs us $12,000 a month to live our life. But then that's not just it, is it? We don't want to just create the income. We also want to create the wealth, the net worth, right? We want to create the nest egg. Again, I've asked a lot of people, like, okay, what is it that you need to earn each month? 12 and 15,000. We can choose either of those numbers. But what is it that your nest egg, you would be comfortable with an unlevered nest egg? This is unleveraged. It's a nest egg. It's there. You can hit it whenever you want. Most people tell me between 2 and 4 million. We can choose 3 million because it's in the middle of that. Okay. So let's take those two numbers. This is basically how you know what you need to do if you want to create a meaningful wealth for yourself. And this takes about 20 years to do. Right. So you got 15K a month and you've got 2 million. Okay. So now we have our two numbers. Okay. 3 million of net worth. Okay. Now we have our two numbers. Once you have those numbers, they're the most powerful numbers that you can possibly imagine in real estate, because now you have a goal. You're no longer, let's quantify what those two numbers mean. That's the next thing we do. Okay, so $15,000 a month, that would be net, okay? But we've got costs in real estate, right? So let's just say they're, and imagine, we're trying to imagine unlevered costs. So imagine they're 25% if they're unlevered. So you need to make about $20,000 gross. Now, $20,000 gross would be, let's say, 10 houses, right, at $2,000 a month. That would be $20,000 gross. Okay, so now you need 10 houses that rent for $2,000 a month. Okay, now imagine those 10 homes today are worth $3 million. So they're 10 $300,000 homes. Okay, so now we know that $3 million is what they are. Okay, so we've got 10 homes and they are $300,000 each. So you're buying $3 million worth of real estate. Okay. Yep. So now we got our numbers. We need 10 houses that are $300,000 each that rent for $2,000 a month that have a value of $3 million. Where we go from there then is as follows. It's going to cost us to get to $3 million, put 20% down. So it's going to cost us $600,000, right? $600,000 down, and we're going to borrow $2.4 million. Okay. So now we have $2.4 million. We're going to put $600,000 down to get our 10 houses. And we're going to borrow $2.4 million. Now, here's the really scary part for a lot of investors. If I asked you today to start saving $3 million, okay, over 20 years.
Good luck.
No. You might even achieve the 3 million, but in 20 years, because inflation basically doubles the value of everything over 20 years. So what you will need in 20 years' time is actually 30,000 to keep your lifestyle going and 6 million. Now, if I asked you to start saving $6 million today, tell me how you'd get on.
No more Starbucks.
But guess what?
No more nothing.
There you go. So the point is that, this $600,000 can actually create 30,000 of net income and $6 million worth of net worth in about 20 years, right? So that's the debt part. The debt part is 600,000, right? So you got to get comfortable with getting, the equity part is 600,000. The debt part is the 2.4 million.
Yeah.
Okay. The time part is about 20 years. And let me tell you how I do it. What's happening over time, like really, really quickly, right? You've got compounded inflation. So let's take inflation at 2.5%. I know it's way higher than that, but let's take inflation at 2.5%. If you compound that year after year after year, your $3 million of assets are going to be worth about $6 million, right?
After 20 years, right? Give or take.
Right. Yep. Your rent, your $2,000 a month rents are going to be about $4,000 a month.
Okay.
This isn't an exact science, but it's about right. So your 2,000 is going to be about 4,000 in about 20 years time. Okay. Now there's another few things about what's happening over time. You're living your life. You just go about your life. You bring up your kids and do all the various sort of things in your life, right? So time. You're also marrying the investment. So don't go out and buy. So if you were to just take this as an actual marriage, each time you buy an asset, you're going to be involved with that asset for 20 years. Okay. So if I was going to go out I'm married with kids, but if I were to go out and find myself single for any reason whatsoever, I'm going to be pretty choosy about what I marry, right? I'm going to marry something I like. I'm going to marry something I want to be involved in. I'm going to marry, I'm not going to keep on with the analogies, but I want it to be clean, middle class, desirable, newer. Because if I buy a 100-year-old house today, it's going to be 120 in 20 years time. If I buy a new house today, it's going to be 20 in 20 years time. So that's like really, really concentrate. I see a lot of people, in my experience, I see a lot of people out there buying really cheap old homes because they're chasing cash flow only. We'll talk about that a little bit later on. I want you guys, you can pick holes in my little strategy later. But, what's happening over time is you're marrying the piece of inventory. So buy well, right? You're also got 10 conventional mortgages each for, we all have 10 only. They're your 10 golden eggs. Don't waste them on a $60,000 property in Omaha. You cannot create wealth with 10 $60,000 homes. You can only create wealth when you have 10, let's say $300,000 homes or $400,000 duplexes or quadplexes or triplexes or whatever it might be. So use your 10 eggs wisely. Okay. So over time, you've got inflation, you've got amortized pay down. You covered these in your profit centers. Now, inflation is working on three areas. Inflation is working on the value of your home. Inflation is raising the price of your rent every year, right? And inflation is also impacting the value of your home. So you've got those things working inflation-wise. So your mortgage is going down, your price, your value is going up. That's what's happening over time. So buy right, buy well, hold them for that, and then you need to do it in enough scale. So I meet a lot of people, and they've got 7 or 8 really inexpensive homes in I don't want to pick on any city. I'm like, that's scale isn't about how many doors you have. Scale is about how much is the gross value of your overall portfolio, because that's what inflation is working on. That it's not working on how many doors you have. It doesn't care how many doors you have. It's working on what is the value of your overall portfolio. That's the only thing that inflation is working on and what scale is working on. So you've got your debt. Know that debt converts to equity over time. How I understand that is, imagine a diving tank. A diver going to jump into the water, and he's got 2 tanks on his back. One is full of debt, $2.4 million worth of debt, and the other one is completely empty. What is happening is, over time, that debt is getting pressed into the other tank as wealth. Right? It's literally coming out in the other tank as wealth over time. So eventually, after 20 years, one is empty and it's got no debt, and the other one is full and it's full of your wealth. So it's actually just, again,
I love that analogy.
I'm Mr. Analogy, right? So I've got analogies. I got more analogies than you'll ever meet, So it's debt by time by scale, knowing that debt converts to equity over time. You need time. So if you're 30, know that the most important thing that you have in your life right now is time. You can always get more debt. You can always get more scale, but you can never get more time. Now, most of my investors come to me. They are busy in their 20s, getting their job, getting started in life. Then in their 30s, they're buying their first house. They're getting started with their wives and careers, and they're busy. And most of my investors come to me when they're about 44, 45. And the reason they come to me at 44, 45 is that they're getting tired. They're getting burnt out. They're really starting to look at their retirement seriously. They're seeing younger people working harder and later into the night than they do. They need to go home for their kids every day, and they're like seeing some 22-year-old who's like sleeping in the office, working 18-hour days, and he gets paid a third the amount. And So these guys are starting to get imposter syndrome at this point in time as you get further into your career. And you start thinking about this. You're like, why didn't I start this sooner? So, and I'm telling you, I speak to investors all day long. We're in 45, 46, 47 years of age. And I could literally, that is when people come to this business. They come to the investing game, 44, 45, 46. And I implore you, if you are listening to this, get started now. Understand that time is what's happening, and understand that debt is your friend. Do it in enough scale, and it takes about 20 years. Now, I keep on saying 20 years. Most people say, oh, well, 30-year fix is 30-year fix. How I personally do it is over the first year or two or three, when you buy your inventory, everyone's really going to look at you saying, oh, he's taking a risk, or he's this, or he's a dummy, or he doesn't know what he's doing. And they'll come back in 20 years' time and they'll think you're a genius, right? So I always say we're a genius the day we buy something, and we're a dummy the day we buy something, we're a genius 20 years hence. What my wife and I do is kind of each year as our rents increase. So let's say we buy a house and it's $1,800 a month. And we come back, let's say 2 years later, it's now making $2,200 a month. Once we have our reserves in place for 6 months reserves, we keep 6 months reserves. And we also keep an eye on our engineering study. So we keep an eye on roofs, we keep an eye on, so we put a little bit aside for those things. But as your rents start to increase in year 3, 4, 8, well, as you kind of own inventory over a long period of time, your cash flow becomes, 20%, 30%. Like literally, I've got homes that they literally cash flow 30% a year. So what do you do with that extra cash flow? Well, you take your 30-year fixed, and on year 4, you take $10,000 and you dump it on to the principal. And then on year 7, you do the same. You take another 10. So what happens is over this 20-year period of this basically real estate, prudence is that, your 30-year fixed comes down to a 27, comes down to a 24, comes down to a 22, comes down to a 19. And basically by the time you get to year 19, if you've been doing this for 19 years, you'll have eliminated your mortgage debt entirely on all of your inventory. Now, some people say, oh, well, I don't agree with that. The thing is that, you should always keep them highly levered and buy more. That's fine. But I'm working off this debt by time by scale algorithm to create a meaningful exit strategy. That exit strategy being $15,000 a month, unlevered, net, and $3 million of wealth. 20 years hence, $30,000 a month and $6 million of unlevered wealth. I'm personally kind of comfortable with that. That I don't need to take over the world. I kind of, 30 grand a month and $6 million in the back burner, unlevered.
I'm good.
And remember, unlevered houses is that's cash in the bank. That's all it is. Right. It's just better than cash. You can just you go get it whenever you want. And I can tell you, and here's another genius thing, when this happens to you for the very first time, and you go into the bank, and I'm not going to kind of, let's say, use a number, but you could go in and you can get, when you own a meaningful portfolio, you could go in and you can get an eye-popping sum of money in 2 to 3 weeks, and it's tax-free, right? And because your rents have now increased, right? So let's say you buy a house that's rented for $1,000 a month, and then, 8 years later, it's $1,700 a month, let's just say. And you've got, 5 or 6 of those, or 10 of those, whatever the number might be. You can just go to a bank and release $800,000 worth of equity, and they give it to you tax-free. Doesn't go on your tax return. This is once you do that the first time, you'll realize then that the debt by time, by scale algorithm, and using your personal targets, identifying your target and for your monthly income and your nest egg. Once you kind of do that, it's mind-blowing. It's life-altering. So anybody out there listening to this podcast, set yourself a goal. Stop worrying about tomorrow. Stop worrying about 5 years from now. That's what I call the meerkat mind. We're going out of our little burrow. We're looking up around. We're with the rest of our friends, making sure they all agree that, we're keeping our eyes on the sky. The one thing, and this goes back to what I told you earlier on about, I traded through the entirety of the last downturn. And the one thing that I personally witnessed was that rents stayed stable throughout. Rental demand was the only thing that I need to ensure that for my debt by time by scale algorithm to work is I need that rent to come in. So I need to buy high quality assets. I need to buy them in high quality locations. And it is my personal experience, having gone through what I think is the biggest downturn in real estate, probably in history, was that if you have a clean, tidy, well-presented home that's priced right, it will rent. And that's the only thing. So when I sleep at night and I add a lot of inventory to my personal portfolio now every year since I literally came to this conclusion, because I suffered from all of the other mindset issues that I've done like 400 flips, and I own small amounts of inventory. Once I came to this conclusion, it freed me from short-term thinking, completely liberated me. And that's what I'm talking about, the matrix. When you liberate yourself from all of the noise, all of the, what's going to happen to interest rates, what's going to happen to the debt by time by scale thing, it just liberates you completely and utterly to focus on you, your economy, your goals. And just know that the one thing that you need is your tenants do need to pay those mortgages to buy high quality assets, high quality locations. And there you go, guys. If anybody actions those debt by time by scale, I think you can pretty much guarantee, if you gave me a 25-year-old and I could mold him in whichever way I chose, I know by the time he was 45, I can make him into a multimillionaire.
I love it, David. And the burning question as you talk about this, I love the shift away from that fear mindset and the fear of what the market's going to do next month and next year and all this. It's easier said than done, though, right? Because we're bombarded with all of this daily information, and the markets are going up and they're going down and this and that. And so, I mean, practically, what do you do to help people shift from that mindset into this debt times time times scale equals wealth mindset?
Okay, the very best example I can give you is as follows. Just when the coronavirus hit, I met a good friend of mine down a local park, 2 deck chairs, 2 beers, and we were having this kind of conversation. He is a well-paid corporate guy and married, 2 children. His wife is a well-paid corporate girl. They are in their late 30s, probably 37 years of age. They have just got to the point where they're nearly finished paying off their college debt. Okay. So we were talking, and we were friends. We never really got into what we did for a living, and he's like, we're talking about him and what he's going through, and he explained to me, he's like, oh man, I'm nearly finished paying off my college debt. And then he asked me about what I do for a living, and I was like, well, I buy and sell homes and I build up a portfolio and I do this. And I was explaining to him this debt by time by scale concept. And he turned around to me, and this is to answer your question. He turned around to me at the end and he goes, wow. He goes, it just seems so risky what you're doing. He said to me. Yeah. And I looked at him, and I looked at him, I said, the funny thing here is I'm looking at you, and what you're doing seems so risky to me.
Yeah.
Like his inaction was frightening to me. So does that answer your question?
Yeah. How did he respond to that? I'm curious how he responded to that.
He said, well, what do I do next? So I told him to read Rich Dad Poor Dad.
Huh. It's a mindset shift.
Lisa, the real answer to your question, and it's quite profound, is that fear doesn't pay you $1. It doesn't pay you at all. This, you think that what's going to happen to interest rates next year. No, you don't. I'm not talking to you, obviously. You think you know what's going to happen to real estate? No, you don't. You think you know what's going to happen to prices? We're at the top of this, that, or the other. No, you don't. I'm not saying that we aren't. I just said you don't know. And it's in that don't know, it's all of, I go to a lot of real estate, like major, very, very big player real estate conferences every year. And in 2015, the zeitgeist in these conferences were, this is all Invitation Homes, the Fed, all of the big names you can name. And the zeitgeist in 2015 was that we got a good year ahead of us, but then it could get choppy. Fast forward to 2018, the zeitgeist was, we see a reasonable bit of runway in front of us, but then, we think there's a lot of choppiness in front of us. 2019, I'd be getting, bearish, or I'd be getting into a defensive stance and all this. Same in 2019, and then coronavirus hit, and, obviously we get put. So the truth of the matter is that we just don't know. But what I love about my algorithm is it puts it all away. It puts it all away. It's gone. It's gone from my thinking, because I don't, most of the people who are investing in real estate, right? They're reasonably, and certainly all my clients, they're very well paid professionals, right? So they don't need the cash flow, right? It's like $200 or $300 or $400 from this one, and a couple of $1,000 a month. It's not going to make a shred of difference in their lives. But what they are all after, what they're all wanting to do, is that one day I want to give up this job. I want to have a residual income, and I want to have a nest egg. If you want those things and you want to use real estate to get them, you have got to put that aside, or you're not going to have it. So again, I see inaction as being, I see that as being, like, it's toxically dangerous from my seat. I wake up every day, and if I do, you guys just saw me in a foreclosure auction, right? That's me. But if I am buying, I am moving forward. If I'm in a defensive position, I'm not moving forward. And I've got one life. And if you think that you're going to kind of wait out the next downturn, let's map that out. No, it's going to take probably a year or two for the downturn to start. It's going to take 2 to 3 to 4 years for the downturn to play itself out. And then you've got to be a genius to know exactly when that downturn is at its play. And then, interest rates might be higher, they might be lower. The banks might have different lending criteria. But at that point in time, you've lost 5 years.
Yeah.
That's what you've lost. You've lost the middle of my algorithm. You've lost the time. Yeah. So, if you think you can, if you think you're Jerome Powell and you've got a good insight into what's going to happen over the next few years, fine. But other than that, don't waste your time. Really, just get busy, debt by time by scale, create a meaningful exit strategy for you and your family.
And that's it, folks. Right there.
I mean, I'm sitting here, I have like a notebook full of notes with numbers and take action. I think bottom line is take action, and the time thing. And David, like I said, I remember when you and I spoke last year, like you really harped on it, because that's the thing with real estate, is the time, and obviously the debt and the scale too. And just kind of I love what you said just about the interest rates and the housing market and, being Jerome Powell. No one knows. That's the bottom line. Like, all you can control is what I think you called your personal economic system. You know what I mean? Like, this is what I'm doing. This formula works. This is going to take care of my family and I, regardless of what happens in the economy as a whole. If I do this, follow the simple formula, take action, be decisive, we will be fine. And I love that. It's that whole control aspect, right? Like, you put it into index fund. And again, Lisa and I both have index funds. We're not anti by any means, but you put it out there and it's just like at the whim of, the invisible hand of the market, and who knows what's going to happen. But if you follow this formula, people need somewhere to live. They need good quality, safe homes where they can enjoy life. And if we provide that for them, that's simply a winning equation. So I love the control aspect of it.
And it's very, very simple, guys. Like, I don't consider myself a smart person, and that's just it. If somebody presents me with a business opportunity that I don't understand, and there's a lot I don't understand, and let me be very, very clear, I'm a low level thinker. It's almost insane. It's in its simplicity, in that you buy 10 high quality homes and hold them for 20 years. Like,
that's it.
How, just and do it now. Don't buy one and see how it goes. Or, if you inherit your mom's house, like, that's not investing. It's like, just get it done now. And somehow people will say, well, I don't have the $600,000. I don't have the down payment. It's not an excuse. Go out there, like, talk to somebody who's wealthy. Talk to anybody and show them, hey, listen, I'm doing this. This is what I'm about. I'll pay you. Take that extra little bit of cash flow, like that $200 or $300 that you've left, and pay off your down payments to your brother-in-law who, owns a law firm. You know what I mean? Like, go to somebody who's got some money. And I can tell you, everybody I know who has money wants to lend it to real estate, because it's one of those assets that they can get a lien holder position. So if you go to, to your wealthy uncle and say, hey, uncle, I want to buy a boat. I need $30,000. I'll give you. He's not going to want to really do that, right?
Right.
So, oh, yeah, I'll give you $300 a month back. He's like, not going to want to do that. If you go to your uncle and say, hey, I want to buy a property. I need $30,000 and I'll give you, a 6% return on your money. And I'll do that. And then, so the lender then is getting, okay, I'll get a second lien holder position. I know that you're a stand-up guy. You're trying to build your own wealth. I want to help you build that wealth, and I get a 6%, and I'm secured. That's a different conversation you're having with your uncle than, hey, listen, I want to buy a speedboat.
Mm-hmm.
So get the money. So getting the money is not the hard part. And that's this place, again, that's part of the matrix. The matrix is the digits in the matrix is the money. It's just there's so much money in this country. It is just a wash with money. It really
and
is.
This is so good for so many of our clients who are just getting started. And that's the hesitation, right? I mean, it's the risk piece where people are like, it sounds too risky and stuff like that. But if they get over that and buy into the fact that real estate is this fantastic investment, well, I don't have the money. And that is the hard part, and that really takes the action of finding that rich person. And like you said, people want to invest in solid assets that are going to give them returns. So don't look at it as like you're asking for a handout for your first property. Look at it as presenting the person who's investing with an opportunity. And if you frame it right and run your numbers and present it well and stand confident, people are going to want to lend you that money. They're going to get their return. They're going to help you build your wealth, like you said, and it's going to be a solid investment for everyone all around. So yeah, present it with confidence, and I think that's a great point.
And go with like actual cogent numbers and say, this is what I want to do. I want, I want to buy a clean house in a clean neighborhood, middle class, and I'm going to get a loan and I'm going to lever it up. There's people doing that all day long. How do you think these syndications work? It's not like they go
exactly.
That's you're literally going to you're taking that money, you're levering it up. Be upfront with wealthy people. Wealthy people want to help ambitious young people. They want to help you. They literally want to help you. And if they get a return on their income or they get a return on their money, and it's in a safe lien holder spot, they're happy with that all day long.
All the better.
It's easy to raise $600,000. It really is easy. So you say get over the fear. Just always know that it's risky to be not doing things. I think it's far riskier to be doing things than not doing things. Far riskier to be not doing things than doing things.
Not doing things. Yeah.
I think it's so much riskier. The money, we just solved that issue. What's the next hesitation that young starter investors might have? What else do they come up against in a mindset, in order to shift their mindset?
Well, if you're doing, particularly for us, I mean, all of our investors have been overseas investing back in the US, and you obviously have a lot of experience with that too. So it's the distance piece for us in particular, not necessarily, real estate hesitations in general, but for our clientele and a lot of our listeners, I mean, again, it's fear. Obviously you don't have the control over a house in Omaha, Nebraska from Sri Lanka that you would if you lived in Omaha. Yeah. So it's just finding those right partners, what would you say to that? Those folks that were hesitant to invest from overseas or even out of state?
I could definitely understand it. There's this human, again, it's almost like the meerkat mind. It's like, there's just like, okay, I can touch it, I can feel it, I want to go touch it and feel it. And you do introduce a certain amount of risk when you're in investing in a town or city that you've never been to, and that you're relying on the team. So, number one, go to an established team that's been doing it for a very long time. Just somebody who's been on the ground, has got a bit of a track record. I would say don't put your money into some syndication where, it's their first outing. I would definitely stay away from that kind of stuff. Don't buy really, really old homes. Don't chase cash flow. Don't chase cash flow into C-class neighborhoods. Don't do that. That's a surefire way of getting yourself into trouble. So if you are overseas and you get this step by time by scale thing, I would say go after like newer B-class properties in growing metros, and you'll do reasonably well. So new are newer. I like urban or suburban. So, not outer suburban. I think that, when you go into kind of a rural environment, you're kind of, you're not in a high demand area. So I tend to mix my personal inventory with, I've got a certain amount of kind of new build suburban property, but in my portfolio, I've got quite a fair bit of what I would almost consider on an investor level, like A-type properties. So I'm talking about $300,000 and $400,000 properties. I've just no hassle with them whatsoever. Mm-hmm. So as I said before, when we were talking about the debt by time by scale, we were talking about the golden eggs, that you have 10 of them per person, or 20 if you're in a married situation. So to use those golden eggs carefully, by using them carefully, you should by extension be going in and buying, B+ or A- type neighborhoods where the number is going to just about work, but you're getting into an A-class neighborhood. You're going to run into a lot less hassle in an A-class neighborhood than you will with a 75-year-old or 80-year-old home in a town that's losing population, that's made of sticks.
Mm-hmm.
Man, yeah, that's such good advice all around.
The other, speaking of other arguments that people come up with, a lot of our clients, they say they're looking 10, 15 plus years into the future. And yet some of what holds them back is they don't need the cash flow right now. And so, they look at the property like, what's a few extra $100 a month going to do for me? And so that transition of saying they have the long-term vision in mind, but yet what is right in front of them is what consumes them and causes them fear. And then they buy a property and then, have trouble that wasn't expected in the first 6 months. And it can be extremely stressful. So I think what's your words of wisdom to help people really think? I mean, you've said 20 years, right? Shift from what's happening right in front of them right now to that 20-year mark.
Okay, so there's a lot there that we're going to unpack real quick. Yeah, number one, when people say, "Oh, I'm going to own it for 5 to 10," no, you're building a 20-year business, and we're building a business. It's not just a part-time job. It's not a gig. It's not a side hustle. It's a business. Okay, so you're building a business. Create a business account, a bank account where all of your inventory and all of your rents goes to this bank account. So none of the activity on your real estate business commingles with your personal finance. The reason I say that is as your rents come in, and then an air conditioner goes out, it's a $3,000 thing. If the money is over there in your business, you're like, fine, just do it. Not a big deal. I have $28,000 there. Now I have $24,000 there. But if that money is in your personal bank account, people feel, I call them the psychological bullets. They literally feel personally attacked. It's like, I bought this and I've just gotten shot by a psychological bullet. But if you completely shift all of you treat it like a business, and all of your inventory and each time you put a down payment in from your personal money, you're just investing in your business, right? Mm-hmm. And then that business account that does its thing, right? So it's no longer personal, right? And that's the first thing I would say is depersonalize the relationship you have with expenses, right? Mm-hmm. The second thing I would say is look at what we're trying to do. We're converting $600,000 to $6 million and $40,000 of gross income a month over 20 years. That's the target of the business. Okay, so a $7,000 roof or a $300 plumbing issue or a $750 water heater is absolutely and utterly irrelevant in that equation. So distance, look at the goal, understand that you're taking a $600,000 down payment and you're creating $6 million of wealth, and segregate all of your income in that property over to a business account, treat it as business, and you won't be so psychologically involved in the day-to-day upset of a water heater, an air conditioner, a roof, or even for that matter, even an eviction. You just won't care, right? And I'd also say it's in the scaling. When you have 11 doors or 12 doors or 13 doors or 18 doors, when you have that many doors and one starts to fail, I don't care. Quite frankly, I don't enjoy it, but I don't care about it. It doesn't affect my mood. I recall when I started investing, it always happens on a Friday night. I have no idea why real estate.
It's inevitable.
It's like 6:30 on a Friday night is when you're going to get those calls, right? You literally go home. You just put your feet up. You're like, okay, cool. It's the weekend, and then bang, here comes the flood alert.
Yes.
Right.
Through your
Busted
door.
pipe.
That's it. Or the air conditioner. It's usually air conditioning here in Florida. How do you deal with it? The real. I used to have such an adverse, relationship with, and I would get all, involved in it and psychologically involved in it and annoyed and feel personally, oh my God, I don't like this. And it's now I literally, I just send one text message back and just go fix it.
Yeah.
That's it. Fix it.
Yeah.
At the end of it, just send me the bill. I don't ask for what the bill is going to be. I'm just like, fix it, send me the bill. And I've got a, mountain of money over here in the day-to-day real estate trading account that just pays for it. And I protect my own mood now and my own approach to it. My psychological reaction to these things is so important if you're going to ever get big. You have got to put away the $300 and like getting upset about that $700 floor that you thought, whatever it might be. The garage door fell off. Oh my God, I'm going to stop investing in real estate. Well, if you take that $700, thing and you say, okay, that's it, I'm not going to invest in real estate, you're not going to get that $6 million.
Yeah.
It's not coming your way. You better have a different way to get to that $6 million. That's my point. So if you're going to give up on the real estate thing, you better have something else.
Yeah. David, I'm wondering, you've covered so much and it is incredible. And I'm wondering if we could shift gears slightly, because your company is West Florida Invest. We have people who are very interested in Florida or very interested in never owning anything in Florida. It's sort of like this love-hate state.
It is.
I would love to hear you talk a little bit about why you are in West Florida, what the market is like there. Share that perspective with our listeners.
Again, that's a great question. And they have this kind of love-hate relationship. I'm going to take it. It's the storms, right? Is it the storms question?
It's the storm.
Hurricanes,
the storms and the rising sea levels.
Climate change.
Okay. So we have a couple of just basic bit of, I suppose, housekeeping here. I only invest and I only buy concrete block home buildings. That's it. So I just buy block homes. I don't buy in flood zones. I buy an X flood zone. So an X flood zone does not require me to carry flood insurance. I do not buy homes with big trees around them, because in the event of a storm, because most storms are not going to be 4 or 5. So let's say your average storm is going to be a 2 or 3. CNN and the various news networks are down on the beach, right? And they're like, oh, look at all the damage on the beach, because so they're the beach homes. So I don't buy homes on the beach. That's number one. From my experience of seeing some storms, is that it's trees, falling tree limbs that are actually going to do kind of 99% of the damage just in the neighborhoods. Okay. So don't buy a house that has loads of trees around it. Again, it's what I love about newer homes. Like even my own home, I had a bunch of trees around my home, and I've removed most of them. They're gone, because that's just it. It's trees. So don't buy a house with trees. Buy concrete block home. Buy a next flood zone. They're all of the things that you can do to kind of mitigate your exposure to any real major storm issue. And from there, I look at the population growth. I look at the way the economy is changing. I look at how many people are moving here. I look at how many hospitals and tech companies are. I live in the old Northeast in downtown St. Petersburg in the Tampa Bay area, and it's stunningly beautiful where I live. I mean, absolutely stunningly beautiful. It's gorgeous. I have an amazing lifestyle, and most of my clients are Californians. In fact, I'm out in California again this weekend, and I see what they get for the same amount of money. And I'm like, Florida provides a lifestyle, incredible people, great culture. And, a lot of people as well, they have this they think Florida is just like Seinfeld's mom's condo building, It's not like that anymore. Florida has changed. That's right. A lot of people think, Florida is just this, seesaw, the seesaw economy of, retirees and oranges. It is, if anything, coronavirus has really, really highlighted the fact that more and more and more and more young professionals are moving here. I can see it. I see it in my own neighborhood. My own neighborhood has just gone from generally an older type of neighborhood, because I live in a historic neighborhood. as those people kind of move out, it's all young families moving in, and they're from DC and New York and Boston, and so I just see it all around me. Just this organic professional growth. So that's why I'm here. I've traveled a lot. I haven't found anywhere I prefer, quite frankly. So I'm here because the quality of life. That's why I'm personally here. But from an investor's point of view, and to answer your question, you should always invest in growth. Population growth is the oil. Now, don't get me wrong. The debt by time by scale works in a really solid market like Oklahoma City. You're not going to see a lot of appreciation, but you're going to see at least a maintaining of inflation. You're going to see a steady market. You're going to see a stable market. Does it go up too much? Does it go down too much? It stays steady over, so the debt by time by scale algorithm works well almost in any market as long as it's, as long as the population is steady or growing. So I would say, do those three things, stay safe, take those precautions I outlined, but equally don't shy away from the third largest population, the third largest state by population in the United States that's growing exponentially. I think that would be, again, that's short-mindedness. I'm not saying put your entire portfolio in Florida, but definitely put some of them, and how I actually diversify even within Florida, because any storm is not going to hit all of Florida. It's going to hit a small bit of Florida. So I have got some in South Florida, I've got some in Mid Florida, I've got some in West Florida, I got some in East Florida. So I basically have my own personal little pockets. So I don't buy one house anywhere. If I'm going to do anything anywhere, it's going to be like 5 or 6 or 7. So I've got some meaningful relationship with the property manager. Yeah. So, you can diversify well within Florida.
Yeah, well, that's a really good point.
Yeah. There's a lot to think about in Florida. People get excited about Florida, but like you said, they also have that, I don't want to do it. Florida's going to fall off the United States. And I'm like, I don't think that's going to happen anytime soon. But
no, the climate change thing, I think it's just, I'm not going to get into the science of climate change. It's real. It's da-da-da-da-da. But, I'm in my lifetime, I'm here 13 years, the beach hasn't moved all that much in my world. It seems to be the same place every time I go down. Now, I'm not, I'm over a glacial period of time, I'm sure that things may or may not happen. What is happening along the waterfront in terms of climate change, like all of those homes are built in the 50s and 60s that are directly on the water, they're all being knocked down, and multimillionaires are coming in. They're buying those older homes with amazing views and blah blah blah, and they're sticking multi-million-dollar homes on them where you got to walk up 12 steps to get into them and that kind of stuff, and the ground floor is just garage. So I think over time, I think those waterfront neighborhoods will just all convert to multi-million-dollar neighborhoods. That's what's happening. So it's not, climate change, let me run for the hills. There's a lot to be said for selling your house to a multimillionaire who wants to build a $3 million house, $4 million house on your little 1960s house. So, but I personally stay away from anything down the water. I stay away from.
Yeah, that makes good sense.
All righty.
And it's very practical. I have one more question. I don't know how many more questions you have, Tim, but I would be curious, David. I mean, out of all of your decades of experience all over the world, what's a story of a mistake that you made and the lessons you learned from it?
Oh, the mistake question.
The mistake question.
Every mistake. I think we're all going to make mistakes. There's loads of little mistakes. There's not like just this big one catastrophic, like, I remember this time. I bought a house in a foreclosure auction, and I kind of tried to push the door in, the front door, and I couldn't get in because it's a hoarder house. And literally there's garbage up to the ceiling of that house and throughout the whole house, where there's just like alleyways of garbage.
Wow.
But that's not a mistake. It's just not a mistake. All of the things that I've ever done in real estate, I've learned from. The big mistakes I've made was being cautious. I didn't build a portfolio soon enough. When I want, a really meaningful one, I'd buy 1 or 2 homes a year. I would say they're my biggest mistakes. They're not these like, I never made a mistake that I regret from taking action. The only mistakes I ever made was inaction. If the truth be really, really told, if I could go back, 25 years and change anything, and change anything about how I approached it, I would have held much more than I did. I would have bought and held more, and I would have sold less. So that's more of a big macro thing. I would probably not have to be on this That doesn't even have to be, but I probably wouldn't be on the podcast. I have worked it out before, and it's in the it's not even a number; it's a noise. You know what I mean? How much all of the homes that I sell for a $15,000 profit here and an $18,000 profit there and a $20,000 profit here and so on. So if I had kept all them, and I've worked it out, it's eye opening.
I don't think you should have worked that out. You shouldn't have run those numbers, David.
I'll tell you what, it helped me. It helped me design the debt by time by scale. It literally helped me do it. When I ran those numbers, I was like, okay, I've obviously evolved in some way, shape, or form, and now I need to really understand how money and how wealth is created. There's a reason wealthy people all have real estate, and I think that I really do feel strongly about this. I think the real difference between how wealthy people educate their kids and how middle class and below educate their kids. Middle class and below educate their kids to use their brains, get educated, get a good job. Wealthy people teach their kids how to use money, how to use other people's money and hold assets over a long period of time and get wealthy that way. So I really do feel that if I made a mistake is that I sold too much, I didn't hold enough, and I didn't realize the importance of time. There you go, Lisa. I know it's not your classic mistake answer, but it's actually the biggest mistake I ever made. Now, I now have to, continue to invest like everybody else, but I wished I'd known what I know now when I was 20.
Yeah, no, it's really meaningful too. And I love what you said about you don't look back and regret mistakes you made by taking action. Like, yeah, there's small mistakes and you learn from them and then you make different actions moving forward. But I think that's really powerful and meaningful.
Cool. All right. I'm glad I could answer that one pretty well.
He nailed it. Nailed it.
Good job.
Best answer yet. Oh man, David, I think we're going to have you back. I have so much more I want to dive into. So hopefully you'll be willing to join us again, and we won't cost you another sale at auction. Hopefully, maybe we'll get you on live. We'll start recording live during your auction and have you win one. I think that'd be good next time.
Yeah, well, if we could get one. So the thing is, I have to walk out now and explain why I lost it to my underwriting team. They're going like, "How do we get on?" They already know.
We're gonna get some angry calls.
No. Just I've got an underwriting team in the office next door. I'm gonna walk into them. They're like, "What happened?" I was like, "Well, So I got to get my butt kicked in about 7 seconds. Once I go into the underwriting team, they're gonna have strong words with me.
Oh man. Tell them we're sorry.
Yeah, sorry about that, guys.
Yeah, David, this has been awesome. Thank you so much. And I mean, I've got pages of notes. I know Tim has pages of notes. Our listeners will have pages of notes. It's really exciting and so many great things to think about and just expand the horizons and the perspectives and start shifting mindsets. Even for Tim and myself, who were already actively in this for years, I'm seeing things. I'm like, oh man, I got to talk to my husband about this and we should look at it this way. So it's really exciting.
No, it's basically once you get that concept of those 5 profit centers, really, really digging into the debt by time, it's the next level of thinking. Yeah. And I would say I recorded this. I spent the winter out in Idaho this winter, just gone, and I wanted to put it down, on film. So if anyone wants to go to my website, it's www.westfloridainvest.com. There you can sign up for our newsletters and our inventory and hear what the team are putting out on any given day. But if you go to the resources in education, I go to videos, I go to the David's 5 wealth creation concepts. Okay. So I've recorded them. I've basically broken it down into 5 little 13-minute type slides where I do an introduction to debt by time by scale. Then I do what is debt, what is time, what is scale, and then what is wealth creation. And then what I do is I take your average, $200,000 house, and I amortize inflation. I compound inflation over 20 years. I amortize a mortgage over 20 years. I add in the tax breaks over 20 years. I add in the increased rent over 20 years, and I have it worked out. So basically you can see, okay, I put $40,000 down here and it pops out the other end down here. So I have a working example. Now I recorded in a nice log cabin in the Teton Valley, so it's a bit dark and woody in the surroundings where I recorded it, and I will re-record it soon. But if anyone wants to go and really kind of dig into this depth by time by scale, please go to my website, go to videos, and you'll see it right there, and you can watch that 5-part series. I really like it. I think it's to me, it's one of the most important things any investor who is busy doing a day job. I think this is the easiest way that I know of for them to get wealthy.
Nice. Yeah. And we'll
link to that.
Yeah, we'll put links to your website, and we can look for those videos specifically and link those in the show notes. So thank you so much for that.
Very cool.
Yeah.
So thanks, guys. I really appreciate it. This is awesome.
It's been our pleasure. It's been wonderful.
Yeah. Well, thank you so much for listening to today's episode of the REI Concierge podcast. We would love if you would share this with a friend and take some time to leave us a review. Thank you again to David. And with that,
happy real estate adventures.